Hey guys, Vulcan Trader here. This is our final video on trading and money management, part 5, which is diversification. So, sorry it took me so long to make this video. I was just tired a couple of nights, and then I was really thinking about all this and how it all works together, make sure that I had it right for you, and it took me a while to do that, and just spent all yesterday evening coming up with this spreadsheet so that we could do the video on it tonight. And um, it really helps teaching stuff to learn things. You really understand it better than you did before. To teach it to someone else, I'd recommend doing that. Whatever you learn, teach it to other people, and help them out too. And those who can't do, teach, right? No, just kidding. But had to give me some coffee because I'm staying up late here. So let's see. Get started. So we explained in our last video on the Kelly Criterion and how it's the optimal amount to risk, but then you get huge drawdowns on it. And I don't know if I ever did an actual trade or like calculate it with a calculator how you do it. So and I know all this stuff may seem boring with money management trading, but you have to learn this. Is like, if you don't understand this, you don't understand your risk reward, your probability, and you have to calculate the same amount for every trade, what your the amount you're going to risk, and be consistent at it. And if you don't do that, calculate that for every trade, you're never going to win. You're never going to be profitable, consistent, and that's what separates the winners from the losers, the best from the worst, and all that kind of good stuff. So we'll do one right here. We'll just for this Kelly Criterion. For example, if you were to do the actual Kelly Criterion, so I got Roku here, which happened to be workout just like what I was doing. So we're do a long position in Roku at 100, and so we're going to risk, so if it gets hit, it's 90, we're going to get stopped out, and then at 120 is the target. I mean, you obviously might hold on to it longer, like we always said before. So how do you calculate it? You got $1,000 account with a 25% position sizing on the stop, so we're buying it at 100 here, stop is at 90, so 100 minus 90 is 10. I do this on all my trades, just a little bit calculator right here, right before I put it in. Simple as that. And you know the formula in your head, which the formula is, percentage of your account divided by the amount the amount of dollars that your stop is to figure out how many shares you're supposed to buy. So in this case, we got $1,000 account. We're going to risk 25% of the account, which is 250. So 250 divided by 10, and you'd buy 25 shares, and then 25 shares is, at $100 times 100 equals actually $2,500, which is more than you have in your $1,000 account. So that's kind of the whole point here, is you'd have to risk, you'd be on 3-to-1 margin essentially if you were to follow the actual Kelly Criterion for this type of trade that I'm about to do for all my examples here, which is pretty ridiculous. And you shouldn't go on margin until you've mastered trading for years and been consistent, profitable probably. So, but that all being said, if you were to do that, you would, your account says only 1,000, but then you would end up, it's telling you to invest. The optimal amount is to buy 25 shares of Roku in this case, or any $100 stock with your stop at 90, and so you'd be at 2,500, which is more that's in your account. So you'd have to have a broker that would lend you 3 times the amount in your account in order to get to that. And then your average. So I did show you what it would be. Your average gain across the trades, which is these two added together, is $250, and then average percent gain per trade is 25%, because 250 is 25% of that. Your max potential loss is $250. Your max percentage loss is 25%. Max potential gain is $500, and your max percentage loss is 50%. And so you have a huge percent drawdown potential, but also a huge percent gain. And then estimated hit rate of the system, we're going to say it's 50% in this case. We don't know that for sure because you'd have to back test it, but I think it's probably about right. So, and then your average gain across all the trades times your hit rate gives you 125 is what we got here. Okay, and then I did, so this is Kelly Criterion on margin. I also did another example here, Kelly Criterion not on margin, just say how you could come up with a single trade example if you wanted to throw all your account in one trade. Don't recommend this, but you'd have to have a stop at like 75. You bought the stock at 100, and then maybe your target's 150, which is possible. Maybe Roku hits 150, right? Or and then you would only have to invest $1,000 in this case when you calculate your stop. And then that one, I did this wrong. Sorry, this is $250, and then be the same thing here, except it's going to take longer to hit that, and then you've got a wider stop on the bottom and a larger target at the top side. Okay, but you still have the same potential drawdowns, all that kind of stuff. So we're going to go to how diversification, how it works across all your account, and how you can kind of get closer to a Kelly Criterion sort of with with the lower risk or partial Kelly. So if we did our account size $1,000, our amount risk on all these examples here is 1%. So we're going to buy all these stocks at once. So that's the difference. In the coin flip example, you flip the coin, it's binary, and it only happens at one point in time. So I flip the coin, and I either gain or lose that amount, and then I don't take the next trade or figure out how much to risk on it until I know what I've lost on the prior ones. With stock investing, it's kind of like flipping 10, or however many stocks you have in your account. In this case, it'd be like flipping 10 coins in the air at once, and then you would have to bet on all of them at once. And then the other thing is that we get even further is like, well, you might get this one, these 5 finish out, but these 5 haven't yet. So then what should you do in that case? And so it's almost like some coins go way higher than the others and, 20 feet in the air, and then other ones only go like a couple inches and something like that. It takes longer for some to land. And so what do you do as all that's happening? And that's what we're getting into here. But the potential gain is $20 on all you get a stock at $100, stop at 90, potential loss is $10, potential gain is 20. Our target is 120, and then so the shares you would buy, you just buy one share in this case. So your amount invested for this stock number 1 is $100, and then we did the same thing, stock 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and then that gets you to a full $1,000 invested. And in this case, your average gain that you can get across all your trades is $100. I don't know if average is the right word, but the total potential loss and the total potential gain summed up. I don't know if average is the right word for that. And then our average percent gain per trade is 10%. The max potential loss is $100 or 10%. So whereas you can see the Kelly Criterion, we can only have we can have a 25% drawdown. The max potential loss we could have is a 10% drawdown to $900. That's if every single stock ends up being, a tails, or which is possible. Maybe you have like October 2018 last year that, something like that could happen, or maybe 8 or 9 of them, you could take a loss on something like that. But usually you wouldn't have that happen and be kind of half and half under normal market circumstances. So, but then even in that case, the max that you could lose is 10%. And some people that maybe you're okay with that, maybe you're not. You got to think about that when you buy your stocks. Like, well, if I'm going to buy them all at once, am I okay with taking a 10% drawdown if all of them get hit? And then that's another reason why I like using 1% is, you can just count up the stocks in your portfolio, and you know that, okay, my max potential drawdown is number of stocks, times 1%, and that gives you your max drawdown at any point in time if you're always using a 1% stop. That's another reason I like it, easy round numbers to figure out your total risk at any point in time. So that all being said, and then our max percentage gain is 20%. Okay, so average gain is $100, and then I'm going to say the estimated hit rate is 50%, so you get about $50. So so the same thing for this one is 125 is about your average you're going to be getting on the Kelly system. We're getting at about 50 here, which is about a little bit less than half, but which is not too bad. Maybe like a quarter Kelly or whatever. I don't know what that is, quarter, third, something like that. And so you can get a across all these at once with diversification being fully invested. You get a smaller drawdown, but you still get it closer to a partial Kelly ratio invested and to get larger gains by doing multiple stocks at once. And then this is our situation too, just to show other ways you play. This right here is probably similar to what Mark Minervini does. He does a 10% drawdown on his max stop. And then this right here would be closer to maybe what Dan Zanger does. He's the world record holder for the largest percent gain in the stock market in a single year. He made 10,000% or something stupid. Like it might be more than that in the .com boom. So you would say you had a stock, same thing, $100, except your stop's only going to be at 95. So you only have a 5% stop, which means that you're with a 5% stop, you can position size more because it's your account size times 1%. So 10 divided by 5, and then so 2. So you can buy 2 shares in that case. So you twice as much in each stock, and then which puts you at $200 per stock, but then your potential gain is larger. And then potential loss is still the same percentage, right? So, which puts us at a total or average gain of 150 compared to 100, and average gain across all the trades. So 15% per trade, your max loss. So this is what makes it look so nicer at first when you first look at it, is that, my max percent loss, if all of them got hit, I can only lose 5%, whereas this one's only 10. And then my gains across all of them is even larger because I have a closer stop, right? So my max potential gain is did I do that right? Yeah, my max potential gain, if all of them went good, that's correct. And then max percentage gain, same thing. But the thing is, even though that looks better, your average gain across the trades is better, and the less your total potential loss is smaller. The hit rate of this system actually goes down to maybe 30-35%, and the reason is because when you have a closer stop, that stop is more likely to get hit, so your hit rate goes down. Because the stock you buy it at 100, it hits 95, then it goes up to 120, whereas in this system, if that happened, you would still be in the trade, right? So, and then if you take the average gain across trades times the hit rate here, gets you 52, so you're still actually about the same, roughly, the same type of situation as this one. And that so what happens really is maybe only 2 of these end up being winners, 3 of them are losers, you buy another 3 and so forth, so you actually end up turning over 10 trades like this one in the long run, and then you get about the same gain. So even though it seems better at first hand, but you might still want to do that even with this one. So you put your foot in the water with 5 trades to start off with. Those 5 trades are at a profit. Maybe they get to 120. You put your stop to break even on those. Then you do another 5, something like that, so that your max percent loss at any point in time is still only 5% because you're only sticking in 5 stocks at a time at the beginning on this one. And then you could do that on all these I'm about to show you. So this one, we're going to do 15 stocks with the even further away stop. So stock price is 100. Our stop's going to be 85. So further away in this case, a 15% stop. And our potential loss is, our potential loss is still only going to be $10. And the reason is we're buying a smaller amount of shares. You can't really buy this amount, but say you had a bigger account, like a $2,000 account, but I just did a partial because math works out the same just for this example, but you couldn't actually buy a fractional share in real life. So you'd just have to have a bigger account to do this. But so, and then, same target, and the amount invested would be $66 and 66 cents in all these. 15 of those equals 1,000, right? And then our average gain across the trades is $50. Average percent gain per trade is 5%. Max potential loss is $150, and max percentage loss is 15%, that's because if every single one of them got hit, which is unlikely, but it's possible, then then you'd have a larger draw. It's the same thing. Maybe you want to do 5. And once those are good at a profit of some sort, you feel like you can put your stop to break even. And then you'd add another 5 and so forth until you kind of dip your foot in the water that way. But so even though this one has a lower average gain per trade, the max potential gain is still the same as the other ones. But even though the or the average gain across trades is lower, then you have a hit rate. This one probably has a higher hit rate, maybe let's say 70-75%, because the stop's further away. Then your average, it brings the, whereas this one, see, the hit rate's lower, so it brings it down to 52 right here. This one puts it like 37. So yeah, it seems lower than these, but you could always, like, say, move up. Maybe your target's 130 in this case or something like that. Or I mean, all these you might let it ride to 130, but just get my point. And then it puts it like this. So, but I wouldn't, knock this one just because it's a little bit lower number. Sometimes this is easier to handle because your hit rate's better, helps you mentally. And if you get a profitable system, you're going to be happy. And, you're beating 80-90% of other traders out there. So I actually did do similar to this with Roku. I wanted to buy, let's see if it'll work. I wanted to hold through earnings on it, but I didn't have much of a profit at the time. So, I bought it at 100, had a 15%, because stock can jump up 20% or, go 20% either way after earnings. So you have a wider stop. I, did a 15% stop on it to give me some room and only have a little bit of risk. So I got a small position in it. I could hold it and then always add more later, right? And so I actually use this in that case with Roku, a real life example. And I think that's about it. I think that's it for our money management series. If I think of anything else, but I think that's about it. And this is the most important stuff out of anything else, and very few people can handle it, thinking about it, going through. But it becomes second nature, just doing a little calculator, or you can ballpark it in your head a lot of times once you get good enough at it, of how many shares you could buy to have the proper amount of risk and that type of thing. So do the hard work, learn this stuff, remember it, get used to it, and make sure you do it on every single trade, and you'll be successful. Like, subscribe, hit the bell, share it with your friends, and comment, tell me what you think, and let me know if you like this stuff and what I should do next, maybe some other suggestions for future videos.